Good morning, everybody. Kirk Spano, and I am expecting the end of the world. I think you should all dig a hole, crawl inside of it, shelter in place until the end days come. The stock market was down a whopping 3% the last couple of days, and I think that should just demoralize you to the point of never investing again. Goodbye. All right, I'm just kidding. I see the breathy stuff that people say. They put in adjectives because they're like, oh, something's bad happening. And I see the people on Bloomberg, more on CNBC. I don't even watch Fox anymore because it's always doom and gloom and it's all political, so I don't bother. But back at the start of July, and in fact, I put this out a little earlier than this. I had to rewrite it once, and I just fixed a typo. But what did I talk about weeks ago? I suggested that the third quarter would be choppy, and I showed historical reasons why that was true. We showed markets from past election years, and we took a look at how the seasonality works. We took a look at how the patterns emerge. A couple months up means a month down, a couple months up means a month down. Well, we got it down April and up May and June, the worst July in 10 years. And now August is starting out with not a lot of happiness. I will tell you, I think it can turn around very quickly, and I'll go through why. Now, if you haven't, and I'm not going to review this again, there's a video 2 or 3 back that you can go through this. But if you haven't read the mid-year outlook, the court, whatever I called it at your service, I think you need to read it, because what is happening is what I suggested would happen. So I've done a little rotating. I've put some cash to work on Thursday and Friday. I sold a lot of puts. I sold a lot of cash secured puts. And on Monday, I'm going to talk about this more in depth about the specific puts. But let me give you the theory. And when you take a look at the calendar and you think about where the stock market is, you have to think about playing through those 2 to 3 month periods. Okay, what is the next 2 or 3 months going to look like based on the last 2 or 3 months? And how can I sell options? Now, if we have had 2 or 3 up months, that means that in June, when I suggested to sell covered calls, probably a good time to sell covered calls. In fact, I have 3 or 4 covered calls that look like they're just going to expire worthless. I closed one because I wanted to sell the stock anyway. But if you know that the market's a little bit high, if those weekly RSI numbers, right, if our technical indicators that show that the market's a little high, a little stretched, a little overbought on the weekly time cycle, because we don't care about days. We take a look and say, okay, the market's been up most of the last 2 to 3 months. It's a little stretched. What's the smart thing to do? The smart thing to do there is sell covered calls, because usually the market will exhale a little bit. And that's what happened in July. So if you had sold the covered calls that I suggested in June, that means that as stock prices chopped or even went down a little bit in July and first couple of days of August, then those covered calls look like they're just going to expire, which is great. You get to keep your stock. You pulled in some income. Wonderful. Now, what happens when the market goes down and it gets oversold? Well, the converse. So you say, okay, we've just had a bad 5 weeks, basically 4 or 5 weeks, really bad yesterday from the standpoint of, even though the averages only went down 2 or 3%, if you took a look stock to stock to stock, there's all kinds of smaller and mid-cap stocks that went down 5 and 10 and even 15% in a few cases, but a lot of 5 to 10% decliners in 2 days. That is a wonderful opportunity to sell cash secured puts, and we're going to go through about 10 of them on Monday, maybe 15 on Monday, and you can get the options that I think that you should be trading. Now, I put out a couple of alerts on Thursday and Friday, and I was in the chat rooms. There's all kinds of stuff for you to do this week, because it's not really the end of the world. This is just the choppiness that I hopefully prepared you for by talking about it for weeks, and you're going to want to deploy your cash. Now, people say, should I average down on this, average down on that? What you should be doing is increasing your positions in the things that you have the highest conviction in. That's what you should be doing. You shouldn't look at say, well, that one lost the most, so I'm going to add to it. No, maybe not. Take a look at the ones where you think, all right, my risk-adjusted potential reward, where I can get the most asymmetry, the most upside for a unit of risk. That's where I want to put my money. And I want to focus on the things that were doing well prior to the correction. The things that have been chopping along, you maybe just don't do anything with. The things that have been plunging, maybe this is an opportunity to flip that money into something else. But you want to focus on your 20 to 30 best ideas all the time. That's all you have room in your melon for. If you think you have room in your melon for more than that, you should apply for Jim Cramer's job, which I think is a lot of superficial melon space in there. But you just want to focus on your 20 to 30 best ideas. And really, at times like this, maybe even whittle it down to a dozen. That's what I'm doing. So I'm whittling things down to my dozen best ideas. I sold cash secured puts on QQQ Friday in my big accounts. So a handful of folks got the QQQ puts. I don't know if they all executed. If they did, great. If they didn't, so be it. I'll make room for those coming up. We had expected QQQ to get to at least 455, and it got down to like 440. 420 to 415 is the ultimate, the bottom target. And that could happen Monday, right? So a lot of people typically they look and say, oh, I missed the big down thing, but I'm scared now, so I'm going to sell on Monday. Typical emotional traders being traders, investor wannabe trader who make a trade when they shouldn't because suddenly they are a trader in their head. And it's just, people are so bad at investing, it's off the charts. So avoid the emotional aspects because what's coming is not a collapse. What is coming is a little bit of a reset. Got several weeks to go probably, but you're going to see more liquidity in the markets. The Federal Reserve has signaled it. The U.S. Treasury is already doing it, and they're about to do it more. So you're going to see more liquidity coming into the markets. And as we should know by now, because I've been talking about it for years and years, is that the broad market is generally pushed by two things. One, it is the employment picture, which we're going to talk about today. And two, liquidity. So between employment and liquidity, if you're only going to have two shortcuts, and maybe that's all you should have, those are two things to look at. Look at whether employment is good and is it falling off a cliff? Is it getting better? Is it staying about the same? I will tell you it's staying about the same. And is liquidity in the markets going up or down? What did I tell you? 2.5, almost 3 years ago now. So it'll be 3 years in the fall. I told you that the Fed wanted to restrain this market for a little bit by pulling back on liquidity. Interestingly, April, it got a little bit of anxiety. It's getting a little bit of anxiety now. I think that I guess it probably makes sense that in the face of super high balance sheets at the retail level, at the household level, at huge money market deposits for institutional and private equity money, that and foreign direct inflows that we're getting, I think it makes sense that the periods of anxiety have been spaced out a little bit rather than a big falling off the cliff sort of thing. Now, your bears, remember, people called me a perma bear a couple of years ago when I called the 2022 bear market. Your bears, your wannabe bears, the people who want to say something right, so they say it nonstop for months and months and quarters and years until it finally happens. I mean, I don't know. That's to me, that's just the clock getting all the way around. They're basically wrong about the debt situation. The debt situation is not at a terminal level. It is not at a crisis level yet. The day's coming where we have a crisis if we don't mitigate it ahead of time. We did some mitigation of the baby boomer retirement, maximum Social Security, maximum Medicare crisis that's coming right around 2029, 2030. I mean, we can see when everybody's on, right? I mean, we know what the schedule is. So in 29 or 30, we're going to have the maximum number of people who can be on Medicare and Social Security. And that is going to be when the budget of the United States is at its peak bad moment. Now, back during COVID, we super overstimulated for two reasons. One, we didn't know how bad COVID was going to get. And two, we knew that if COVID wasn't as bad as it could be, and it wasn't really the end of the world, that we'd be mitigating the next crisis by spending a ton of money on the last crisis. And that's what's going on. So we printed a whole bunch of money, trillions and trillions of dollars. We stimulated trillions and trillions of dollars. We helped lower income and middle income people a lot with the extra unemployment and the extra food stamps and the extra money for healthcare on the exchange, extra Medicaid. If you were a low income person or even not working, or a middle income person or not working during COVID, and for about the next year and a half, you didn't do so bad financially because the government stepped in. And then we did the Inflation Reduction Act, which is basically an energy bill. It's an all of the above energy strategy, which is what we need, because if we don't do all of the above, I've told you already, based on what I just learned and kind of already knew over at the Hard Energy Conference, the United States can't drill, baby, drill. Can't. It's imaginary. This whole drill, baby, drill thing, imaginary, can't happen. Do you know why? Because there ain't that much to drill, baby, drill. We have 5 to 10 years of growth in the Permian Basin available, and all the other basins are basically just replacing oil, so they can't really drive production higher. They're just trying to keep it level, and in most cases, it's drifting down a little bit. Alaska, the new oil that Conoco is going to be getting out of the ground in 2 or 3 years, a lot of it will be heavy. But that's fine, because we need to refill the reservoirs. Again, lots of moving pieces, but the bottom line is that sometime around 2030 or into the 2030s, the United States cannot, by a function of not having it, cannot increase oil production. So by about 2030, we need to be transitioning to a more electrified grid for powering EVs. Because if we are still all driving gasoline vehicles in 2030 and into the 2030s, we will become very beholden to OPEC again. Do any of you want that? No, you don't. I don't. Nobody does. So you want to have a more equal relationship, or maintain some hegemonic power, and you can't have that if you are beholden to the oil that will start to come from OPEC again in the 2030s. So think that through when you vote. If you think that getting rid of the EV policies and the solar and the alternative energy and everything that's going towards clean energy is a good idea, then you're basically voting for more dependence on OPEC in the 2030s. And whoever, if Trump wins and he really does shut down a whole bunch of the alternative energy policies or delay them, then it means that we're going to have a period probably after he's gone, if he leaves, where we are very dependent on OPEC again. So there are long-range things that we have to keep in mind, but at the moment, we have a lot of oil. We have a lot of natural gas. The idea that we should export more natural gas, we are going to have twice as many natural gas exports next year as we did last year. That's how much it's doubling in a 2 to 3 year period. Should we continue to build more export facilities after that? Right now, there's a pause. I think that's probably smart. We just saw 150 plus applications for electricity generation in Texas, a part of a program they have to use the natural gas that's there. So everybody says, oh, we can't get the natural gas out of Texas. Fine. You don't need to build a pipeline, because they're all build more pipelines. You don't need more pipelines. You know why? Because you just put utilities and data centers where the natural gas is, right? And you use it for energy there to electrify the oil fields, to run data centers, to basically power Texas and the surrounding states by fully integrating those grids, which is mostly on its way. And suddenly, rather than flaring off natural gas, which is the worst thing you can do with it for the environment, now you're using it, you're recycling a bunch of the carbon, right? Because you get a tax credit put in the ground. Oh, look, Inflation Reduction Act, tax credit, put carbon in the ground. And that allows them to use that natural gas. So you take a look at all these things, and you're like, okay, if we know that energy has led to inflation in the past and housing is leading to inflation right now, but demographics are deflationary, where are all these things coming from that lead to whether or not the economy is going to fall off a cliff or we're just going to keep drifting upwards? So I'm going to show you some charts. The Daily Shot had a great couple issues this week. I took a look at Forest for the Trees and FS Insight and about 10 other websites. Goldman Sachs, Morgan Stanley, just write down the list. I've been sitting in front of charts and writing down notes. Basically, the conclusion is this: you really ought to be a buyer. You ought to be buying these dips with not, the people say I'm buying with both fists. No. Just pluck little plucks. Just, I want that one, and I want that one, and I want that one. So, blah, 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 blah. You see, too fast, too big. Little bites. And if you sell cash secured puts to October is a good month. Why October? because we know that coming out of October, there's almost always a post-election rally. I think it's like every election other than two, going back to the Great Depression. And I think before the Great Depression, I'd have to look again. There's always a rally, and it lasts anywhere, it lasts till spring. And we'll see if we get the same thing. I suspect we do. And I'm going to show you some reasons why. But first off, let's summarize what's happening right now with U.S. Treasuries. You just had a bunch of Congress people on the Republican side of the aisle question Janet Yellen, why are you writing so many short-term Treasury yields? I mean, the interest rates are higher for 2 and 5 years than they are for 10 and 20 years. Yeah. Look, the 10 to 20 year and 30-year interest rates are relatively stable. 10-year comes down a little bit more than anything else, or up a little bit more than anything else, because that is a foreseeable time frame. When you start looking at 20 and 30-year interest rates, those are long-term investors. They're basically telling you, look, if it gets down below a certain amount, if we're not beating inflation over that time period, we ain't buying the bonds, right? So 20 and 30-year bond rates are pretty much always going to be from around 4 to around 5. A little higher, lower, sometimes if there's huge economic events. But those are pretty anchored interest rates. So it's the shorter end of the curve that moves. Why? Because that's what the Treasury and the Federal Reserve can control, and that's how they work in conjunction with the banks to create money, to do lending, to create leverage when there's not a lot of leverage. Oh, right now there's not a lot of leverage. So think about that. We have seen the stock market do pretty well without a lot of leverage. What happens if they increase liquidity and interest rates come down? That means leverage will go up, right? Because people speculate. So as the market gets better, people will speculate because money gets cheap again. I don't think we're anywhere near the top of this stock market. I think that we are going to see a fourth standard deviation event sometime next year, maybe 2026, but I think probably next year. So you should be buying these dips because as liquidity goes up, as interest rates come down, as speculation, right? Because there's twice as many traders now as there used to be. As speculation goes up, you're going to see a lot of things go up. And these are the types of cycles where small and mid caps just crush it. Showed you a chart last week from FS Insight that it's very likely that small caps rise 50% over the next 6 to 12 months. That's a big move. If you're picking well and you get an AST Space Mobile here, Aspire Global there, an American superconductor over there. If you get a double, a triple, a quadruple here and there, right, it offsets all the ones that just kind of bounce around or go down 30 or 40 or 50% because small caps do that too. All right, so make sure you read the mid-year outlook. It is chock full of good stuff. It's at both services. And let's take a look at some chart. Unemployment went up a little bit, but what does that really mean? The dark blue line is now, and then these are all the other lines from recent years. Now, I think 2021, I think we all understand that is hugely skewed. I think 2022 is probably pretty good one to look at. That's orange, but things were still, all still in the rebound. I think the years to look at are 2015 to 2019. So if you take a look at, there you go, there's 2015, there's 2016, there's 2017. We're right on 2017. So what does that tell you? Basically, everything's about the same now as it was from 2015 to 2019. All the pre-COVID years, and we know that 2015 was kind of soft. And, I thought we were going to get a big stock market correction, but those 2014 to 2016 years were the 2 years of just choppiness sideways. It was an unusual period. What did they have that prevented the market from really crashing? 2 letters, starts with Q, ends with E, right? Had a lot of QE. So I would expect that we get QE again here soon, probably in 2026 or 7, whenever we get the, oh my God, it's starting to break moment ahead of the boomer thing, and then just tons of QE into the early 2030s. I don't think you're going to see a lack of liquidity because they know how to use that monster now, right? So I think that the really bad stuff that's coming from the budgetary standpoint in about 5 years, it's fixable. We're going to do what Japan did. We're just going to print money for half a generation, and then the problem's going to go away. Ultimately, markets react the way markets react, and people have a lot of short-termism because everybody thinks they're going to get rich quick and they're going to make that, billion-dollar trade. But on aggregate, what you're seeing in Japan right now is, even though their standard of living has remained very good, they're having a hard time with all their markets. So all the things that they did going back 30 years now, so almost 2 generations of policy, they're digesting right now. And ultimately, they're going to have to live off of their investments and what they produce for the world economy. And what we know is that machines are going to produce for the rest of the world the same way that Japan and China and other export nations used to produce for the rest of the world. We know that the fourth industrial revolution is bringing production closer to the end consumer, because if a machine can make it here, a machine can make it there, because you don't have to, have slave labor anymore. All of a sudden, export economies become much more regional, right? I mean, we'll work with Canada and Mexico because transportation costs are low because we got rail systems. Europe is going to work a lot more with Europe, and they have rail systems out to, really across the Eurasian continent area. So they'll work well with India. India can work with a lot of places. India's geographically in a good spot to be an export nation. They have educated, low-cost labor, and they have a lot of people who want to still improve their standard of living. So you're going to have a lot of people over the next 2 generations moving from your low income and unemployed groups, into the middle class category. The Chinese have to transition to being more consumer based. They can have a boom if they switch more to consumerism, and they don't have to consume the way we do, right? We just eat. We just consume everything. They don't have to get like that. But if they consume at the level of the Europeans, China would have the ability to absorb their own production, probably for a generation or 2, and you would see some stability. The big risk of less global trade is that countries become belligerent with each other because they're not as integrated. The economic integration of the world over the last several generations since World War II has led to, we still have regional conflicts and little, wars, but we haven't had a world war. And if you take a look at the history of World War II, it was clearly a result of the policies, the punishment of Germany after World War I. What we probably need to avoid, and this goes against the rhetoric, this goes against the old, America first mantra that's out there right now. I just watched Rahm Emanuel on Wall Street Week talking about how China steals technology. Well, we've known that for forever, right? We've known that forever, right? They had a policy that was right in our face when we let them into the World Trade Organization, which I still think was right, that if you wanted to produce domestically, you had to have a domestic partner who basically was there to steal your technology. The corporate executives allowed it to happen because they didn't care if China stole the technology because they were getting paid. Now, in hindsight, people say, we should have let them steal the technology. Really? Did you really want a whole bunch of Chinese folks who were hungry and cold and poor and had the ability to blame it on America? No, you don't want us to get blamed for other people. And the idea that we shouldn't share with the rest of the world the things that we learn how to do 5, 10, 20-year head starts, the idea that we wouldn't support increased standards of living around the world is just, you're asking for war. So you don't have to lose standard of living to help others have a better standard of living. And that is something that I think a lot of people, they think that it's a zero-sum game, and it's not, right? It's not a zero-sum game. You can raise standard of living across the world. All of a sudden, and this goes back centuries. If everybody has a chicken in their pot and a roof over their head, much less likely to go to war. And those are the things that you have to keep in mind when you vote for politicians who will enact policies that could lead to bad things down the road. All right. So jobless claims, normal-ish, right? Continuing jobless claims, normal-ish. Job cuts, super low. You should really expect a little bit of increase there. if the economy doesn't stay up in the twos and threes. But really, we haven't seen big layoffs, and that's because the people that were hired in the last few years, they know what they're doing now. They know what they're doing now. And get this, they're getting more productive. These are all estimates from Goldman Sachs and Morgan Stanley that say that unemployment is going to stay about the same. The unemployment rate went up because more people entered the workforce. We talked about. So here, Nomura showing that the average wage increases are lower now, and that corresponds to inflation going down and the labor market not being quite as tight as it was a couple of years ago. Remember all the times we talked about that. All right, small business isn't planning to hire a lot of people. That's a shame. We do need to do something about small business in short order, because at some point by the 2030s, if we don't have small business and we don't have millennials and Gen Zers taking the place of the boomers who are retiring in small business, then everything becomes more big corp driven. And what do we know about big corporations? They'll gouge you if they can, right? If they can create an oligopoly market with monopoly pricing power, they'll charge you more. We just saw it. But, and this is something Luke Grumman talks about that I've been talking about, will AI lead to a production rebound? Well, let's throw out the bottom and just look from here, right, to here. Productivity, if it chops down, we have a problem. But what if this trend pushes productivity way up? Remember, throw out all the COVID numbers, just kind of squish them together. What if productivity keeps going up? You have people working from home who are learning how to get their stuff done. And you know what happens when you work from home? Initially, you're not very efficient. I can tell you this because I went through this back in 2016. Started working from home and I goofed off too much. And I'd get up early to start my day, and then I screw off, and then I do things. And then at night, I'd be like, I got stuff to get done for tomorrow. So all of a sudden, you're working from 9 o'clock at night until midnight. People are learning to manage their time much better now. This is why if you don't have an interactive job with your other employees in your company, you don't need to be in the office every single day. Now, I do think there are good arguments for collaboration, and that in-person collaboration is often better than Zoom meetings. However, the work from home thing's just not going away. It's just not going to go away. So if you can harness people becoming better at working from home, then you're probably going to, see your productivity numbers go up. And I think that's what we're at the front end of. Plus, the AI tools that people have now, or is just starting to get, are probably going to drive even better productivity. So what happens if we get better productivity? We are able to deal with the boomers at the big corporate level. The boomers who are retiring won't necessarily have to all be replaced at the corporate level. And that means what? Corporations become more profitable. So we have seen profits kind of chop for 2 years plus now, and we're just starting to see the profit levels go up again. Now, when people talk about companies beat their estimates, who cares? They move the estimates so that they can beat them, right? What you need to do is take a look at what are aggregate earnings. And aggregate earnings just started to turn up again. By next year, you're probably going to have earnings be even higher. Running into the next economic slowdown, though, which I think could happen in 2026, doesn't necessarily have to. You know my opinions of what can happen. If we get a recession in 26 or 27, or we get the skip straight recession, right, where we just have a bad quarter dropped in here or there, a digestion period, then probably corporate profits level off again before they head up again. And then you get your boomer crisis and everything falls apart, and then you stimulate the hell out of things and you buy back money and blah, 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 and you QE. So keep in the back of your mind the opposite of what the drumbeat is. Everything's getting worse. Everything's going to go to hell. Or we're going to huge debt problem. Everything's going to explode. It's probably not what's going to happen. What's probably going to happen is you're going to see little ebbs and flows and adjustments by the Treasury Department and adjustments by the Federal Reserve. You're going to see QE at some point. You're going to get breathy moments in the market that last a few quarters, potentially here and there. But mostly you're just going to get digestive periods because productivity probably is going to get better and better and better. And that's going to offset the boomers leaving the workforce. And especially when you add in immigration. Interestingly, I saw two things. One was in the Business Journal, and one was on Market Watch. Actually, it was three things, and where was the third thing? Oh, it had to do with insurance. Oh, Grumman talked about it actually. The migration to the high risk climate locales is over. It's ended. It's done. You are going to see more people moving away from Florida going in the future. You have your people that are already there to just hang on for dear life. However, and some of them are going to die because of it. The cost of insurance in Florida completely offsets the fact that there's no income tax. So you go down there because you love it, you like the warm weather. That's great. I love Florida. I go from time to time. But, and again, you have to accept the climate change is real. I don't even care if you have a reason for it. You can just observe that it's happening. The hurricanes are getting worse, and the cost of insurance, which was subsidized by the bull market in bonds, because insurance companies are mainly in bonds. The bull market in bonds over a very long period of time, from the 80s until COVID. That bull market in bonds, even though bonds probably don't get horrible because interest rates probably don't go very high, there's just not a lot of gains being made in bonds for a very long time. Very, very, and we're talking a very long time. And as you see a shift of people no longer moving south to places that have wildfires, that have floods, that have hurricanes, that is going to move a lot of money in the insurance industry, in the banking industry, in just regular industry. You're seeing the boom in Kentucky and Tennessee and Ohio right now. In Wisconsin, we just got that data center from Microsoft. You're starting to see a shift back to the middle of the country and the Great Lakes region in particular. And Grumman talked about that. Grumman actually said, if it was a trade, maybe you short ocean real estate and you go long the real estate of interior lakes. And you've heard me talk about that for years, that we were just on the very front edge of that. It's the basis of Jolene and now my son going into real estate to become experts on climate change migration and where you can have a place that you're safe from just about everything. Those movements are going to be monumentally impactful on things like construction and industrial spending and how tax receipts move. So as certain states lose tax receipts, other states will gain tax receipts. That makes a difference for your municipal bonds. It makes a difference for the companies. The companies that just moved to Florida, I think that they're making a mistake. All these financial guys that are moving to Florida because they want to game the tax code. If Florida's smart, they're not going to subsidize any of them. They're going to make sure that, they get something out of it, because that next hurricane, like I told you, it's coming and it's going to be horrific. And they're all going to say, oh my gosh, this is bad luck. It's not bad luck. It's very predictable. The insurance models are telling you it's going to happen. And who has the biggest buildings in the city? Well, it's not the oil companies or the casinos, usually the insurance companies. So just got to wrap yourself around these big secular trends when it gets a little bit noisy today. We know productivity is going up. We know that labor costs are coming down. Again, that's supportive of corporate earnings. ISM manufacturing. Normally we'd have a recession already, and we're not. Torsten Slok over at Apollo, I talked about it last week. There's really no signs of recession. When I showed you all these numbers being normal-ish, that's it. Everything's normal-ish. Talked about the downside surprises for the last couple of years. It's bottomed out. Look, it's starting to work its way back up. These are all going to go up. One of the things that we saw in the last quarter is that shipping containers coming to the United States spiked up. That means that the slowdown in transportation and rail systems and trucking, all those things that had slowed down in the first half of the year, what's going to happen in the second half of the year now that all those shipping containers are hitting the shores right now? All that trucking, right? So we burned off inventory basically in the first half of the year. Corporations slowed down, right? The ISM manufacturing numbers came down, and now they're going to go up. And consumer spending, which had flattened out a little bit, is probably going to go up in the second half of the year, especially when everybody has a sigh of relief because somebody gets elected. I don't even know that it matters who. I mean, I think in the long term it matters. I think in the intermediate term it matters. But after elections, we always have a sigh of relief. We just say, okay, this is the way it's going to be for 4 years, right? Employment at the ISM level bottoming out. That means it's going to go up. When it's up here, it goes down. When it's down here, it goes up. Is it going to be next month? I don't know, but it's going to be soonish. Construction spending, which had shot up, fell down. What have I told you about with the private equity firms that I work with and the ones that I just talked to? Can't get a 15% internal rate of return at the current interest rate. What does that mean? It means interest rates have to come down. The markets are telling the Fed, we need interest rates down. We need you to reverse the cycle. The Fed, Jerome Powell said the other day, probably going to lower interest rate. And now the markets are starting to price in a half-point cut, which is what I thought should have happened back in March. I thought they had a moment in March to say, hey, let's lower rates a half point. Let's just take something off. Not necessarily the start of a rate cutting cycle. It didn't happen. But then they could have lowered rates by a half point in March. A bunch of projects would have got off the ground over the summer. And then they could have waited to see if inflation happened, which it probably wouldn't have because it hasn't. Half point probably wouldn't have stimulated it. You could have put to work all those immigrants that had come in, given them work visas, start to get them into the system. By the way, did you know that immigrants paid over $100 million in taxes last year? Yeah, but they cost us money. Actually, on net, including the illegal immigrants, we were probably $30 to $50 billion dollars, 30 to $50 billion to the good on the tax balance sheet, right? Benefits versus what they brought in. So we were good $30 to $50 billion, which is, it's a sneeze, but it still was positive. But more importantly, they helped bring inflation down. Just showed you that wages are going up slower. That is a direct result of the immigration and AI. Corporations have it good, man. I'm telling you, corporations have it good. That's why private equity companies buy corporations and they keep them private. There's a problem with private equity and private credit and the public markets right now. And it has to do with the way the tax rules are written. The tax rules need to be changed so that more stuff becomes public earlier, like at the point where they're crossing into profitability, not after the multiple has gone through the roof and you're selling high to the public. Some private money guy sells high to the public, right? Kept it to himself when it's cheap, let it go up, then he sells it. That is a big problem with confidence levels in the markets. And there's only two things that really need to be changed. One, carried interest needs to be gotten rid of unless you're putting direct capital into something out of your own checkbook, and it is new. It can't be gaming the market. And second, the real estate transfers, the 1031 exchanges, major overhaul needed. If you're building something new, fine. You can cash out of one thing to build something new, but just swapping properties. Oh, I'm going to take his old property. He's going to take my old property. And now we don't pay taxes. Crap. Shouldn't be going on. And the progressives talk about it all the time, but even the moderates talk about it. And we got within 2 votes of fixing it. But Kristen Sinema, and actually I think Joe Manchin was on the right side. Kristen Sinema blocked it. She deserves to be out of politics. Kristen Sinema was bought and paid for, and that's all there is to it. She was a problem in the market, and hopefully she never gets elected to anything again, and she just go running her mouth. And hopefully she doesn't even get on TV. But she is not good for you in most cases, and you can like her or not like her because of your party or whatever. But the fact is that she was bad for the market-based system. And if you are a conservative, you should like market-based systems. You shouldn't like monopolies and dragons hoarding their money. Yeah, whatever. People have their inconsistencies. Private construction spending actually leveled off. It needs to go up again. There is an absolute limit here, right? Because you should get a boom, and then you probably should have 5 years where it goes sideways again because you have new stuff. And there is a finite amount of stuff you can have, right? I mean, it doesn't make sense to overbuild either. Residential are way behind. Automotive sales have been choppy now for 2 years. If interest rates come down, you'd expect auto sales to go up. The projections I've seen all say 17 to 18 million, maybe 19 million new cars sold by the end of the decade. Why? Because if the transition to EVs happens, you'll get a lot more people buying cars, at least for a while in a window, and then it comes back down into this range. U.S. government bond yields plunging on the short end of the curve. Remember, I talked about this 3 months ago. I talked about this, that you should buy the 2 and 5 year treasuries. 10 years have come down, and this is where the curve can move, right? But when you get out to the long-term curve, right, you see the whole curve here, your 20 and 30s are not going to move very much. It is the shorter duration, from Fed funds rate to 5 years that do the most moving. The further out on the curve you get, the more stable the rates are, because again, long-term investors, if you're really buying 10 and 20 and 30 year bonds, You're just trying to preserve wealth that beats inflation. It's not really an investment for making money. It's where the dragon puts its money. So the U.S. Liquidity Support Buyback Program, and I actually have that stuff all up here ready to go. But Luke Grumman talked about it. I talked about it 3 months ago, I think it was. When I talk about liquidity, what we know is that as liquidity goes up, markets get more excitable, speculation takes off. We don't have a lot of speculation right now from the standpoint of leverage, right? Lots of traders being traders. Oh, run over here, run over there, run over here, run over there. But not a lot of leverage. There's really not a lot of leverage in the markets. I've shown those numbers before too. As interest rates come down and as more liquidity gets added to the market, and they're just trying to massage this. They talk about how for the next 2 to 5 years, they're just trying to massage it. What happens towards the end of the decade? They know what's coming. I'm not out on a limb here. They know what's coming too. They're getting ready for it. So they're going to raise the buybacks to $30 billion per quarter, the refunds, basically the government buying back debt and issuing new debt. And they do this to keep the market liquid and add more money to the market. So they were doing $15 billion a quarter. They're going to bump it to $30 billion a quarter. Again, it's not a lot of money, but they are going to add, actually, I might have $30 billion a quarter. It's not a lot of money, but they're adding billions of it. Looks like they're going to add about $14 billion to the market here in the short term. So when you go through all this, all you're really seeing is that they are gradually increasing liquidity, just enough to offset the fact that we have a lot of debt, and because interest rates are high, it's costing us more. I've showed you before that if we lower the interest rate down to between 2 and 3% on the Fed funds rate, which will bring the 2-year Treasury down to, in the 2 to 3%, then you can lower your cost of debt service by about a third to half. And if we do have that one moment where the government gets a chance to issue some additional long-term debt because people think that the world is getting to be deflationary, then all of a sudden you can write a little bit more 10, 20, and 30-year debt at those low interest rates and then lock in that 3 or 4% rate for a little bit longer. We did that during COVID, but there was a certain amount of debt that you can't lock in just because there's not enough buyers. No, China has been selling our debt. There's a deal to be made there, right? You can reintegrate with China. You can just say, you know what, pay us a little something for the technology that you want that helps your people. Let's work something out where you can export to the emerging markets. We can export to the emerging markets. And between us, we can do some swapping. But, we need our jobs and you need your jobs. So let's figure out where the balance is. There's a way to do that. You've got a military industrial complex that would prefer that it's a more adversarial relationship. Eisenhower said that decades ago when he gave his farewell speech. To Trump's credit, that's one of the things that he does recognize, that the military industrial complex pushes us into situations where we're butting heads with people. Because why? Because then everybody arms up. But there are economic ways to fix a lot of the conflicts out there by making the pie bigger. Remember, and I haven't done this in a while, right? It's not about your slice of the pie. That is what poor people, right? And I'm telling you, that's what poor people. And if you think this way, if you think getting a bigger piece of the pie is the way to really make money, then you're a poor person. I don't care how much money you have. The way to make money is to grow the pie, right? Make that circumference bigger. And then everybody's making more money. That's how you do it. There's ways to do that. Both parties have their pros and minuses, their pros and cons, their pluses and minuses. But that's the way that we need to think, is about growing the pie, not your slice of it. And the people who vote based on slice of the pie, they're bad. They're bad for the economy. Not bad people. They're just bad for the economy. They don't get it. So explain it to a kid. Explain it to a millennial or a Zer about your experience, right? Watching things for 30, 40, 50, 60 years like a lot of us have. It's about growing the pie. And then everybody wins, conflict goes down, standards of living go up. Why haven't we heard that in a political speech? That's good stuff. All right, Treasury Borrowing Advisory Committee, report to the Secretary of Treasury. There's good stuff on there from the end of the quarter, first half of the year. It's talking about debt service costs, right? So the interest on the debt has gone up because interest rates are higher. So as interest rates come down, right? I just showed you this, or just talked about this. As interest rates come down, debt service goes down. Pretty standard recipe. Now, the other thing, and it's in here somewhere. One moment, please. There's some really good charts here. I'm going to tell you to go find it. You can go to this report. It's at the Treasury Department. This is what it's called. Corporate income taxes. There we go. Oh, I found it. Bam. Corporate taxes. Look, that's a green line. It's not high enough. And remember, the idea that the tax cuts paid for themselves, they did not. Tax cuts, look, corporate income taxes went down. And they've never gotten back to that point until after COVID. Who was president after COVID? And they didn't even get to change the income tax rate. They just passed things like the semiconductor bill and the Inflation Reduction Act and the infrastructure bill. So the idea that Democrats aren't good for business is silly. I've described them as being a little bit of a drag once in a while, but the Republicans have been boom and bust for the most part. Going back to Reagan, even Nixon, going much further back than that, than the post-World War II era when everything was getting rebuilt, that shouldn't count. That's an anomaly caused by a war. And we just saw anomalies caused by a pandemic. You have to try to rationalize over long periods of time what is normal. And we need this green line to go up. It doesn't have to go up a lot, right? One of the things that we could do is increase the Social Security taxes from the employer side, not the employee side. If you ask major corporations if they would like to see Medicare for all, the majority of them, the last poll I saw was right around 70%, would say, yeah, let's just do Medicare for all. Get us out of the health insurance benefits business. We'd be way more efficient as a company if we just paid a number and we didn't have to worry about profit margin of the insurance company that's, helping us with our insurance. That's why so many giant corporations self-insure. There are much more efficient ways to handle the United States healthcare system. How do we know? Because we spend twice as much as anybody else per capita, and our results are not better. You can argue that they're about the same, right? We have more super high-end medicine, but do you and I get it? Not many of us. I have a pretty good healthcare plan, and I can write a good check. It's still, unless I have something really bad, it's just not going to happen. So we need income taxes to go up, and that'll be a product of the stock market and real estate markets doing well. I do think real estate's got to level off at some point because you need the percentage of income going towards housing to flatten out. There's a lot of people spending up to half of their money on housing. That's too high. It's supposed to be down around 30%. And they stretched it to 40% right before the financial crisis. And we're stretching towards 40% again right now. So that is the biggest spot where you're seeing inflation that has to be gone. And weirdly, by lowering interest rates, probably get one pop in housing prices, but then with more inventory, it moves sideways. And that's what I think is going to happen. I think we're going to get a pop in real estate as interest rates come down. And then once interest rates are low and there's lots of building for an extended period of time, 5, 6, 7, 8 years out, and as the boomers start, to sell properties or their families start to sell properties, by the 2030s, I think you're going to see real estate move sideways, maybe for half a generation to a generation. Between now and then, it'll go up. So we can see tax receipts all go up by really simple mechanisms. Just so you understand the Treasury buyback program, if you go over to your handy dandy ChatGPT, they describe it for you. It's a debt management, market liquidity, and monetary policy set of tools. One right in the middle, right? You never answer the one in the middle, but maybe you should. Or do you always answer the one in the middle in multiple choice? I can't remember. Market liquidity. They're adding, and that's the big takeaway today. They are starting to add market liquidity right this now. And because of the multiplier effect at the banks, right? The leverage that they take, you're going to get 5, 6 times more money into the system than what they actually put in. Because a loan on a loan on a loan on a loan, right? When they loan out money, they take back and then they loan out again. So you usually get $5 or $6 for every dollar that goes in from the Treasury or the Federal Reserve. That's what's coming. So when you go through this, you start to look at the numbers and you realize that this is a perpetual thing. They're going to keep doing it. They're going to keep adding billions and billions of dollars. And if things really slow down, they'll add more billions and billions of dollars. What is that good for? That's good for stocks. We're starting to see earnings go up. We're starting to see more liquidity. We just had a breather. Maybe the breather lasts through the month or even next month. Hard to know. But if you're a put seller, you should be aggressively selling puts now to October. At some point, we're going to get a big rally, probably by the first quarter of next year. I'm going to tell you to write a whole bunch of covered calls again because that cyclical and seasonal thing where the best gains are made from November to April, it's pretty tried. There's a good data set. That's pretty much when all the gains are. So selling your puts into October You might get some of them put to you, but if you do, they're at low prices. And then you have 6 months to make a whole bunch of money. And then in the spring, you write covered calls and you trim. So take a look at some of this stuff. If you really want to get in depth, right? If you don't want to have to buy a $1,200 a year subscription from Grumman, here, I just showed you where all the stuff is coming from. All this information is out there. I'm not making anything up. It's right here. They're talking about what they're putting into the system, and it's coming. The Fed has finally gotten what they wanted from tightening. Inflation came down. Unemployment hasn't ticked up because there haven't been layoffs. The rate went up, but that's because of the new people in the system, which will help suppress inflation in the future. AI is at the very front end of its productivity boom, very front end. This is going to last 20 years where productivity goes up. The 4.5-day work week is practically here. And I suspect that we stick with a 4.5 or 4-day work week in perpetuity, but that people get more vacation time, right? You're going to start seeing 5 and 10 days added to people's vacation time just as a matter of course. They're not going to be needed to work that many hours. The problem you have pushing back against that is middle management that wants to be middle management. What did I tell you back in 2020? The big threat from AI isn't manufacturing jobs, right? Because we already had machines. The big threat is the middle manager. Middle managers that just shuffle things around, that don't have great interpersonal skills, that don't have the ability to look forward, right? That are just there to like look over your shoulder. Those types of middle managers over this next generation, they're going away. They're going away. So for the folks who aspire to be a middle manager because the boomer is retiring, that job may just disappear. Organizations are becoming more horizontal, right? I've talked about the 5 things that everybody needs for a win-win situation. Everybody wants autonomy. Everybody wants affiliation with something. Everybody wants a role within their affiliation. Everybody wants appreciation. And most people want some status, but the ones that thrive on status are the ones that nobody likes, right? Call me boss. Call me Mr. President. People have a lot of pride. And if you've studied the middle way or Buddha or anything like that, you start to realize we're just all small. Accept where you are, and what you will see is a little bit more clarity that we all just do our little part. We help the people closest to us. If we make a bunch of money, we can help some more people. And along the way, we have decisions to make on a daily and weekly and monthly and annual basis over the course of our lifetime. If we make a lot of good small decisions without making any horrible stinkers, you gradually pile up wins, and it works out. You're going to have setbacks. You're going to make a bad decision, something you'll get unlucky on. But if you understand this big picture and how all the moving parts move together, if you get away from the people who cheerlead, especially the ones who are trying to scare you, probably going to do really, really, really well. And that's a message that I'm putting out there again, because I think the young people need to hear it. I think the millennials grew up in a period of 9/11 and the start of social media and the financial crisis, all in their 20s. And I don't think it was a big shift, right? They grew up and then everything changed in their 20s, which is when your hardwiring pretty much becomes hardwired. And I think they need to hear it from some of the older folks. Hey, I remember all this stuff. And here's the thing, as an older folk, as somebody who's getting older, you have to fight being stubborn. Back in my day, it's not exactly how you want to put them. So I think as you reflect on what's going on, and you keep in mind what are the big things on the economy, it's energy, it's employment, it's taxation, it's the monetary system, but it's all part of this big demographic thing, right? How the population grows, and we're starting to see population slow down. How population moves, climate change is a big new thing that's going to affect the world. Again, this goes back to George W. Bush. His administration was the first one to really, really start citing climate change immigration as a national security issue, right? It had been talked about since the 60s. It became a national security issue when George W. Bush, in the shadow of 9/11, started thinking, okay, why would people have to come here? How do we control immigration? How do we vet people? Because we need them. How do we vet them? And what the quadrennial report that the Pentagon used to put out, and they call it something different now. They still do it. It's called something different. They realized that a lot of people are going to be coming here, especially by the southern border. They knew this a long time ago. And a lot of it's climate push, right? People can't farm where they are anymore, or tourism disappears, or a hurricane wipes them out. You know, that, and along with government instability south of us, makes people look for a better life. And, you can, if you have Instagram, you start seeing some of these comedians show up in your feed if you're like me, and they talk about how, yeah, I travel all over the world doing comedy shows. I'll tell you what, I'm always happy to come back to America. As much as I love seeing the other stuff and being in other places, America's still pretty good. So, if you think of things in terms of standard of living and how the big machine, financial economic machine work, you can make good investments based on things that should happen, will generally eventually happen. Getting the timing perfect is hard, almost impossible. But if you know that something is moving in a certain direction, don't get squirrely and say, well, it's not moving yet. Sometimes it doesn't move for years. For years. Take a look at the space stocks that we bought. They went down for 2 years, and suddenly, we added right near the bottom on a couple of them, AST Space Mobile, Inspire Global, and they went up 300 and 500% or whatever they've gone up in under a year. Companies like Ametis, everything is going in the direction that they said it would go in, except that it's been slower because COVID, higher interest rates, and government regulation. Nothing's materially changed. Timeline has moved. Now, the timeline moving on Ametis, we're at a point where we need to see a lot of things get done in the next year. If they don't, that means that the financing becomes more difficult and more expensive. So far, they've avoided that because their private equity partner has been very supportive for 15 years. You wouldn't expect that to change. There hasn't been any threat, but some of the debt comes due next spring, and they're going to have to figure something out. It'd be better if they had a lot of revenue so they didn't have to pay big interest rates or penalties. They have airlines lining up to help them with the SAF plant, the same way the AST Space Mobile got AT&T, Verizon, Rakuten, and American Tower to prepay some stuff, buy into the company, and then do contract. The airlines are going to do the same thing with the SAF plant for Ametis, right? Folks, I read for a living. That's really what I do. And I have an AI that helps me now, 2 AIs that help me now, well, in ChatGPT. And if we can focus on that 2, 3, 4, 5 year time frame versus 2, 3, 4 months, you can be much better off for it. Now, I've gone over this before. The average holding period for a U.S. investor on a stock is 10 months. That is asinine. It is dumb zuckery at the highest level. You want to own stuff, you try to be profitable by year 2. It doesn't always work that way. But the way small companies work is you have hockey sticks. The way the medium companies work, you just have, up and to the right for an extended period as they go up their S curve. Large companies and mega caps, if they have monopoly pricing power, they can keep going. If they don't have monopoly pricing power, and especially if they're CapEx heavy, they're cyclical. And ultimately, most investing in the S&P 500 is cyclical. Companies just are on a sine wave. If you can buy near the bottom and sell near the top every 2-3 years, you're going to do pretty well. Those are hard trades to make in a world where there's all sorts of governments and central banks and corporations trying to put their thumb on things to move it in a certain direction. One of the reasons I'm not a big fan of heavy CapEx companies is that they're always heavy CapEx. Ametis is an exception. Why? Because I've seen how refineries get bought, right? If you look at the history of Marathon Petroleum, they bought Tesoro, they bought, I believe it was Western Refining or something. If you take a look at how they created Marathon Petroleum, it was through acquisitions. So from the 90s to now, take a look at their chart. And they probably have peaked out. And now they're going to go through a long digestive choppy period. US Bank, same thing. So you have the benefit of history telling you this is about how things work. Do you see anything that's similar? History doesn't repeat, but it rhymes. New York Community Bank Corp, I'm telling you, it has all the characteristics of US Bank in the 1990s, post 1994. If you have consolidation in the banking industry, which government policy is pushing for, which Federal Reserve policy is pushing for, your aggregators, your consolidators in the banking industry are going to do very well because we're a big overbanked country. We've talked about the banking system a bunch of times. It's not that banks are going to collapse. It's that a lot of banks, to avoid collapse, right after 30 and 40 and 50% haircuts, are going to have to merge. And then they merged. They combined their deposits. They closed some branches. We just saw a headline about some bank that did that out east, right? Two banks merged out east, and they got rid of like 1/6 of the branches because they were close to each other. It made sense. People were surprised. Why? Two banks merged, and now you got two branches within a mile of each other. Why would you keep them both? And that's where you get the synergy. This is where small business needs to be able to go out and buy those old bank branches and put a different business. Certainly don't need another bank. But as banks merge, as regional banks merge, and as they absorb the local banks that aren't converting to credit unions, because a lot of them are going to do that, as families don't have heirs that want to take over a small bank where the family made a bunch of money and they just want to cash out, which a lot of them do, right? Third generation, that's the cash out generation, folks. That is the cycle. Somebody builds something, the kid takes it over, the grandkid sells it. I'm seeing that with one bank here in town. I bought their shares and sold them and made 20% just on a little trade. I wanted to be able to get their records as a shareholder, and they're clearly going to either get bought or merge or turn into a credit union. I think they're going to merge within our credit union is what I think is going to happen. But you're seeing all these things out there. But the regional banks, they get the benefit of favorable accounting rules if they participate in the U.S. Treasury market. What's the other thing that we saw with the U.S. Treasury market, by the way, in the last week? Are stable funds, stablecoin. There's bills out there now about how stable coins will have to be regulated basically like money market accounts. We talked about that in 2020. In 21 and 22 and 23, and now it's finally happening. And it comes under the idea that things that make sense will generally happen eventually. So all this stuff, nothing's negative, folks. I'm just telling you, everything's normalish. I told you interest rates were going to come down a little bit. The neutral rate is between 2 and 3%. That's where they're headed. Did it take a little longer than we thought? Yeah, because inflation was just a little bit stickier, but ultimately it's been transitory. A lot of prices are coming down. The things that aren't going to come down are the things that are taxed on the income level. So assets are going to keep going up. Food is probably going to stabilize. Insurance is going to be higher in some places than others. You're not going to want to be in the high insurance places. And really, you don't even want an insurance company. Even if you're in a low insurance state, you don't want an insurance company that does business in the high insurance states, because they can say that they're segregating those pools all they want, but still there's a bottom line. So you want to deal with companies that on the insurance side, and this is just a personal finance tip, you don't really want to deal with companies that have a lot of insurance operations on the Gulf Coast or in Florida and even parts of California. So there's a lot of that going on. Somebody mentions that there's more options being traded. Yeah, there is, but that's not really leverage, right? They expire. And the reason that we're option sellers for the most part, I mean, it's very rare that we buy a call. But the reason we sell calls and sell puts is because the speculators have moved into the option markets because they all think they can outtrade the market. We know that 80% of them can't, 10% of them tie, and 10% of them win. They drive option premiums high. Option premiums are way higher now than when I started doing this 25 years ago. You are making a lot of money to be an option seller. And that's mainly what I did last couple of days, is I sold a lot of options. So I'll get that list out so that you can look at it. It's going to be a very comprehensive list. And I'm not telling you to do them all. I'll put something in there that basically says, look, if you have or want these positions, you're trying to increase it, you can decide what you want to do with regard to buying stock based on, is your primary goal income, or is your primary goal more balanced, that you want some stock and some income? So, there's a lot that you can do out there. But I put out a piece Thursday towards the end of the day, and then I put a bunch of notes, chat room things on Friday. And I mentioned like 10 different stocks that I was selling puts on or rejiggering a little bit, adding a little bit of exposure. I think that you're going to want to do that. There's not a lot of stocks are back closer to 52-week lows and highs. And their lows are pretty low. So I think that as this liquidity goes up, as we get closer to the election resolution, you've got a month or two to really fill out your portfolio. And I love selling puts to October. I really love it, because either they just expire and I have all that income, in October, the rally really shouldn't have started by then. So I can buy a bunch of stuff in October, whether, either with cash or with things being assigned to me at a low price. Then I can ride the 6-month rally that probably follows. Historically, that's what happens. And we figure it out in the spring. Maybe we sell a whole bunch of covered calls. If you really are happy with the idea of just collecting income, you're tempted to write the January puts, but the reality is that you'll make more money in most cases selling 2 puts, one to October and then selling another one to January in October. So you're better off generally selling 2 puts sequentially than you are selling one longer one. It's just the way the time value works. You can find exceptions, but mostly what I just said is right. All right. I will have the options, stocks and options of the week. I've combined those, by the way. I just got tired of keeping them separate. So I combined the service at fundamental trends. Now it's just 2 services instead of 4. And then margin of safety investing is kind of a hybrid. So now I have 3 services that are all kind of unique. If you don't swing trade, but you do sell options, margin of safety investing is the best value. If you swing trade, rare is the best value. And if you don't do anything with options at all, you're just stocks and ETFs, fundamental trends has a stock and ETF trends service, which is cheap. And right now you can still get a 76% discount with code freedom24. I extended it to just after Labor Day. So if you want stocks and ETFs from me, freedom24 to get a 76% first year discount on stock and ETF trends. All right. It's not really the end of the world. This is an opportunity. I talked about it several weeks ago. Hopefully you heard me. And if not, hopefully I quelled your fears of the end of the world, because everything's kind of normalish. And the Fed is starting to add liquidity. The Treasury is starting to add liquidity. And we're years and years away from the big boomer retirement crisis. And if we handle things right the next 4 years, it might not be a crisis. We'll see. Japan avoided it. Maybe we can too. We've got some advantages they don't. We have resources, right? We have more security. We don't have China on our back door. There's a lot of reasons why the United States can avoid a crisis. It all comes down to a more circumspect approach to handling government and industry and trying to find a way to get more people to participate from the bottom up. All right, everybody, have a great day.